If you've accumulated a large position in your company's stock, there's a good chance someone has already told you to diversify, and they're probably right. But execute that without a plan, and you could potentially hand the IRS hundreds of thousands of dollars you didn't have to. A concentrated stock position is one of the best financial problems you can have. And at the same time, it can be one of the most expensive if you approach it carelessly. So, today I'm going to tell you some ways you can unwind it strategically, keep more of what you built, and do it on your own terms. Because the goal here isn't to avoid taxes at all cost, and it's definitely not to let the tax bill keep you from making smart decisions. The goal, on the contrary, is to make good economic decisions first and foremost to help you protect and grow your wealth. However, if you are aware of and use all of the tools at your disposal, that can be done while saving hundreds of thousands of dollars, if not more, in taxes. That's not a trade off. Done right, those two things can happen at the same time. Now, before we get into specific strategies, let me explain why the standard advice of sell the stock, pay the tax, diversify falls short when the numbers get large. For most people, say someone with $50,000 in company stock, the math is straightforward. Pay the tax, sell, move on. The bill is manageable, and the concentration risk is real. But when you're sitting on 1.5, 3, $5 million in a single position, that's a fundamentally different conversation because we're not talking about a mere tax inconvenience. We're talking about a tax event that can materially change the trajectory of your wealth and everything that wealth is supposed to make possible. At that level, a decision isn't just about the numbers, it's about what you're actually trying to build for yourself, your family, your legacy. That context matters, and it's going to shape which strategies make the most sense for you. So let's get right into them. The first strategy I want to walk you through is using options contracts to protect your position while you unwind it. But let me back up for a second because the foundation of any good divestiture plan is actually a lot simpler than most people expect. The most straightforward path is to sell gradually in controlled pieces spread across multiple tax years in amounts that possibly keep your gains within a lower tax bracket. That alone can make a dramatic difference compared to selling everything at once. But the question I always get is, well, what if the stock drops 40% while I'm in the middle of that plan? And that's a completely legitimate concern. And the larger the position, the more tax years you'll likely need to spread the sale across, which means more time exposed to that risk. That's exactly where options come in. So, what is a stock option? Well, think of it like insurance on your stock. Just like you pay a premium to protect your home against damage, you can use options to protect the stock position against a significant price decline, giving you the right to sell at a set price within a defined window without being forced to act before you're ready. A specific strategy called an options collar takes that a step further. You buy protection that puts a floor under your stock. Say it's trading at $100 and you ensure that if it falls below 80, you're covered. In exchange, you agree to cap some of that upside, say at $135. Between those two numbers, the stock can move however it wants. You're protected on the downside, you retain meaningful upside, and the cost of doing this is relatively low. Here's why that matters. What you've essentially done is taken a highly concentrated, volatile position, one where a bad quarter could crater your net worth, and made it behave much more like a diversified portfolio, without selling a single share, without triggering a single taxable event. That stability is what makes a multi year selling plan actually executable. Instead of watching the stock every day, anxious about what happens if it drops before the next tax year, you now have a defined range. You know your floor, you can stick to the plan. For someone who needs 2, 3, 4, or even more years to unwind a large position tax efficiently, the collar is often what makes everything else sustainable. It's also one of those strategies where the structure really matters. A well designed collar and a poorly designed one can produce very different outcomes, which is why this is an area where specialist advice tends to pay for itself many times over. The next strategy pairs directly with what we just talked about, and together they form a really powerful combination. It's called direct indexing, and for someone in the middle of a multi-year selling plan, this is one of the most effective tools available for reducing the tax bill along the way. Here's how it works. Instead of owning the S&P 500 through a fund, you own the individual stocks inside it directly in your account. Same market exposure, but because you own each stock individually, you can harvest losses on the ones that decline and use those losses to offset the gains you're realizing as you sell down your concentrated position. Quick clarification on that. Tax loss harvesting does not mean we're trying to lose money. It simply means we're positioning to take advantage of the fact that in any given period, some stocks will inevitably be down, and we can put those losses to work. Here's a number that puts this in perspective. In 2025, the S&P 500 gained roughly 16% for the year, but 171 individual companies inside that index were actually down. In a traditional index fund, you'd have zero losses to work with. In a direct indexing account, you could harvest losses on each of those 171 stocks and apply them directly against the gains you're realizing as you sell your concentrated position. Your overall return still mirrors the index, but your tax bill along the way is meaningfully lower. There's also an enhanced version of this strategy that uses leverage to add additional long and short positions on top of the base portfolio, sized so that your net market exposure stays exactly the same. You still participate fully in the upside of the index, but now you have a much larger pool of positions to harvest losses from in any direction that the market moves. Over time, this approach can generate substantially more realized losses that can be used to offset capital gains. This works really well for business owners who are planning to sell in the next few years, and it's equally powerful if you're sitting on a very large position with a substantial embedded capital gain. If you're facing the sale of your concentrated positions over time, coupling that plan with direct indexing or its enhanced version can be an extraordinarily powerful combination. You're not just managing the sale, you're actively offsetting the tax cost of it every step of the way. Okay, next is a strategy that most people have never heard of. It's called an exchange fund, and I think it's one of the most elegant solutions to this problem. Quick clarification first. When I'm saying exchange fund, I'm not talking about an ETF. That's a completely different thing. An exchange fund, sometimes called a swap fund, is a private investment partnership, and the way it works is actually pretty intuitive. Let's paint a picture here. You're not the only person sitting on a large, low basis stock position with a tax problem. There are many investors in the exact same situation, often holding different concentrated stocks and trying to figure out how to offload that concentration risk without getting hit with a huge tax bill. An exchange fund brings those investors together. Each person contributes to the concentrated stock. In return, each investor receives a proportional ownership interest in the fund, which now holds a diversified basket of all of these contributed stocks. No sale happens when you contribute, no taxable event. You've exchanged your concentrated position for a diversified interest in a partnership, and the IRS allows this without triggering capital gains tax. And here's what makes it especially powerful: diversification happens immediately. Contribute your NVIDIA stock, for example, today, and if it drops 30% tomorrow, you're insulated. That decline hits a small slice of a much larger basket, not your entire net worth. After a 7-year holding period required by tax law, you receive that diversified basket of stocks. You've unwound a concentrated position without ever writing a check to the IRS on the original gain. Now, the trade offs are real and worth understanding. You're committed for 7 years. This is illiquid capital, full stop. You give up control over which stocks end up in the basket. However, the fund sponsor will typically make an effort to ensure the fund represents a broadly diversified portfolio. For some people, that 7-year lockup is a deal breaker, but for others, particularly those with a very low cost basis and no near term need for liquidity, it's a reasonable price for what is otherwise an extraordinary outcome. There's also an eligibility requirement worth knowing upfront. Exchange funds are only available to what the SEC calls a qualified purchaser, meaning you need at least $5 million in investable assets to participate. So this isn't a strategy for everyone. But if you are in that situation, this is one of the most powerful tools available to you, and one that most people in that situation have simply never been told about. The last strategy I want to cover is really a whole category of options, and it's one that often resonates most deeply with people who have built significant wealth: charitable strategies. And if giving is already a part of your life, your appreciated stock may be one of the most powerful giving tools you have. Here's the core idea. Instead of donating cash and holding on to stock you will eventually owe taxes on, you contribute the appreciated stock to a charitable vehicle. You receive a deduction at full fair market value up to certain limitations. The charity pays no capital gains tax when it sells, and you never recognize the gain. So let's say you have $100,000 worth of stock with a $10,000 cost basis. You avoid tax on $90,000 of gains and get a deduction on the full $100,000. Same charitable goal, just executed in a way that keeps significantly more wealth in your hands and directs more to the causes you care about. One of the most accessible entry points into charitable strategies is a donor advised fund, or DAF. Here's what makes them so flexible. You contribute your appreciated stock today, you get the full fair market value deduction today, and you avoid the capital gains tax on the sale. But you don't need to have a specific charity or cause identified yet. The fund sits in the DAF, can be invested and grow tax free, and you distribute them to the organizations of your choice on whatever timeline makes sense for you this year, next year, or over the course of a decade or more. You get the tax benefit now, and the giving happens on your terms. For some people, the donor advised fund is exactly the right tool. For others, on the other hand, the goals are more layered. Maybe you want the stock to generate income for you during your lifetime, or you want to pass significantly more wealth to your family, or both. That's where trust structures come in. There are structures that can take a concentrated, highly appreciated position and convert it into a diversified income stream, potentially for the rest of your life, while deferring or eliminating the capital gains entirely. Others are designed to support the causes you care about now while transferring significantly more wealth to your family later than a traditional estate plan would allow. And some do both simultaneously. These structures sit at the intersection of investment planning, tax strategy, and estate planning, and they genuinely require all three working together to execute well. But for someone with a charitable intention and the right set of goals, the outcomes can be extraordinary. We're sometimes talking about strategies that let you give more, keep more, and pay significantly less to the IRS in the process. Now, here's something I always tell my clients about this entire category. These aren't tax tricks. They're a smarter way to carry out generosity you were already planning. The charitable intention needs to be real, but if it is, how you give matters enormously. Done right, you can give more, keep more, and build a legacy that reflects what actually matters to you. Everything I've just described, collars, exchange funds, direct indexing, charitable strategies, those are all just tools. And the mistake I see most often is people jumping straight to the tools without first getting clear on something far more fundamental. And that is, what do you actually want the rest of your life to look like? Where is your career going? Does having this wealth feel like permission to take bigger career risk, to start something new, to bet on yourself in a new way? Or does it support a different vision? Slowing down, stepping back, finally doing the work that actually feeds you. These aren't financial questions, but they drive every financial decision that follows. And once you're clear on that, the strategy, the timing, the tax plan, all of it simply becomes execution. Two things worth sitting with before you do anything else. First, ask yourself how much conviction you genuinely have in your company. I'm not talking about habit, inertia, or the fact that selling feels uncomfortable. But ask yourself this question. If you didn't already own this stock, if it weren't your employer, would you put 40, 60, or 80% of your net worth into a single company? And if the answer isn't a resounding yes, that's worth paying attention to. Second, understand where this position sits relative to what you actually need. There's a meaningful difference between someone whose entire financial security depends on this one stock and someone who already has a fully funded, diversified base, and this position represents upside above that. The first person needs to act with real urgency. The second has more flexibility. Knowing which one you are changes everything about how you approach this. If you've built meaningful wealth inside a single company, you've done something genuinely hard. That stock represents years of work, loyalty, and in many cases, real sacrifice. But respecting that doesn't mean holding on to your company stock forever. It does mean being intentional about what you do with it and having a plan that reflects not just the taxes, but what you're actually trying to build. Your company stock got you where you are today. The plan gets you where you want to go. If any of what we covered today applies to your situation and you'd like to think it through with us, visit hapfinancial.com. You can click on the link in the description below. No pitch, just a real conversation.